Hello, everyone. We're just waiting a couple of about another 30 seconds for some people to jump in, so we will be joining soon. Thank you.
Wait, that's how.
Okay, thank you, everyone. I think we will jump into it. So, good afternoon, and thank you all for attending today's Super 101 webinar. We'll give, as I said, we're just going to give everyone a couple of minutes or a little bit to come through now. But whilst they're coming through, I'll let you know my name is Kelly Barnes and I'm an account manager here at Brighter Super. An important part of my role is guiding our valued members towards a comfortable retirement. Now, by the end of today's webinar, we aim to give you some useful information on the basics of superannuation. I'm also joined today by one of our member accounts specialists, Gemma Ballantyne, who will be monitoring your questions in the chat today as well. Now, at Brighter Super, we acknowledge the traditional owners of the lands on which we are meeting today and pay our respects to their elders past, present and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role in this region. So today, guys, it's important to understand that the information and examples contained in the presentation are general in nature and have been prepared without taking your account into your personal situation into consideration. It is important when making decisions about your super options that you obtain the relevant product disclosure statement and target market determination and consider your own personal circumstance. You can access both of those documents and the financial services guide on the Brighter Super website. Now, today's presentation will run for about 30 minutes. Many of you have submitted questions already, which we have tried to incorporate in today's presentation. You can also post questions in the Q&A feature during our presentation today, which we will aim to answer directly. As mentioned, we have Gemma standing by as our moderator today. They've been with the fund for around 3 years, and Gemma is regularly out in the field providing super health checks to members in different regions all around Queensland.
Thanks, Kel. Hey, everyone. Looking forward to helping answer your questions today. So don't forget, if you do have questions, then just pop them in the Q&A feature on your screen today.
Thanks, Jan. We should have time for questions at the end today, and we'll try to answer as many as possible. We'll also be running some poll questions throughout today's presentation. When the question pops up on your screen, please just click an answer that is appropriate to you. Now, don't worry about taking any notes. We will send you this recording in the coming days as well. So before we move into our main subject, I'd just like to take the opportunity to briefly explain who we are, and as we now have some non-members that are joining us today. Now, the merger between LGIA Super and Energy Super, plus the acquisition of Suncorp Super, has enabled us to increase our size and scale, yet we remain committed to investing in the personalised member services that you all know and enjoy. We serve over 230,000 members with over 32 billion in funds under management, and we received double-digit returns for the balanced accumulation and balanced pension options for the year to 30th of June 2024, so the financial year just gone. Now let's talk superannuation. So the purpose of superannuation is to preserve savings to deliver income for a dignified retirement alongside government support in an equitable and sustainable way. So most of us, we know we make our contributions every year, but we don't really think about how much we actually need until we come to probably around age 50. And then most of us think, oh, I haven't thought about it. What do I do from here? So let's just explain a bit about what superannuation is and how it works. So super is linked to your employment. Your employer contributes money into your account on your behalf. Your money is then invested. Any fees and insurance premiums are deducted, and then what's remains is your benefit. So superannuation is important now as it takes a long time to save up enough money to retire on. Making good decisions early is very essential. There are benefits to contributing extra to your super. The money your employer is putting into your super for you is a great start, but by adding a bit more, you can make a huge difference to your retirement balance. And now is just the time to start to think about your super, even if it feels like it's a really long way off. As I mentioned, there are benefits to contributing extra to super. The money your employer is adding is a great start, but we can use the power of compounding interest to really make a difference. So you don't need to add a lot to see a big difference, as we can see on this screen here. By contributing an extra $20 a week over 40 years, your balance could be an extra $132,000. If you add an extra $50 per week over 40 years, your balance can be over $330,000. This is assuming a 5% return compounded annually before fees and charges. So you can see that those small changes now can make for bigger differences over the long term. Using our previous example of $20 per week until age 60, let's take a moment to look at how different this could be if you started this extra contribution earlier or later in life. You can see by starting earlier, you may have more time to benefit from compounding returns on your superannuation savings. Imagine the difference that $125,000 would make to your retirement compared to $13,000. Now, there are some important points to consider before deciding whether to add extra contributions to your super. With all contribution types, there are contribution caps to be mindful of, and we'll cover these off in a little bit detail as we go in this presentation. Depending on your level of income, some types of contributions may be more or less tax effective, so you should carefully consider which one is right for you, and we will cover that off. You should review your budgets, obviously, to ensure you're able to take that reduction in your take-home pay, and any additional contributions you make also form part of your what we call a preserved amount, which means you cannot access this money until you've met your preservation age and a condition of release. So that's generally retirement age. So now that we know what superannuation is and the potential benefits of increasing contributions, we need to talk about the ways to put money into superannuation. Now, there are two types of contributions: concessional contributions, or otherwise known as before tax contributions, and non-concessional contributions, which are sometimes called after-tax contributions. The concessional contribution limit for the current financial year has just recently gone up to $30,000. Concessional contributions are made from pre-tax money, so they include everything that your employer pays, plus anything that you would salary sacrifice, whether that's mandated or voluntary, and anything that you claim as a taxable deduction through your tax return. If you exceed the cap, excess contributions are taxed at your marginal tax rate, and that's done through the ATO. Non-concessional contributions come from money that have already paid your own income tax on. As a result, these contributions are made after tax, and therefore no further tax is taken off them. Under current rules, you can potentially contribute up to $120,000 per financial year of these non-concessional contributions. If you're under the age of 75, you can use what's called a bring forward rule, which means you can contribute up to $330,000 in one financial year, depending on your total superannuation balance. Now, there are other considerations as well, so please consider seeking personal financial advice. Later in this presentation, we will discuss the options to be able to help this. So what are the ways that what are the best ways to contribute money to superannuation? Let's have a little further look. Now, it really depends on your overall taxable income. Australia has a tiered personal taxation system, which means that we get taxed at a progressively higher rate the more money we earn. If we are earning between $45,001 to $135,000, your overall marginal tax will be 30% plus the Medicare levy, which is currently 2%, if applicable to you. If you're earning over $135,000, your tax rate will be higher, generally. Now let's apply this to super contributions. An after-tax contribution simply means that the income tax has already been deducted from that money before it's contributed to super. There's no tax on entry to the fund and forms part of your tax-free component within super. And we'll chat more about that later. If your employer allows you to salary sacrifice, or if you claim a tax deduction on any after-tax contributions, the contributions are then taxed at the rate of 15%. So for those earning between $45,001 and $135,000, generally this means you may be paying less tax on your before-tax super contributions. So what is the best way to contribute? It really depends on your personal circumstance, and you definitely should seek further advice as to what works best for you. We have a range of different advice services, some of which is included in your membership here at Brighter Super, and as I said, we'll chat about that a bit further on in this presentation. Now, before we move on to the next example, let's ask our first poll question. Do you salary sacrifice currently? Can see some results coming through. Thank you. Alrighty. So it looks like it's a nearly a 50-50 split, just a little bit more on the yes side. So for some of you, you do and you're aware of it and you're across it. And for some of you, you don't. And for the ones that don't, I definitely suggest reaching out to us, maybe booking a super health check or getting one of our personal advice services to chat to you about potentially how that may be able to benefit your situation. Let's have a look at a example of this salary sacrifice. So let's assume a member is contributing $5,000 to their super, and they earn between about $45 and $1 and $135,000. If they make an after-tax contribution, the tax will be paid of $1,500. If their employer allows them to salary sacrifice the contribution, or if they claim a tax deduction, they'd be saving around $750 per year based on the difference in the tax rates. So that's extra cash in your pocket. It's up to you what you want to do with this money. You may need it for immediate financial commitments, or you might be using it towards saving for your retirement future. It can potentially be a great way to boost your retirement savings. And remember, that's all about what lifestyle you want to live in retirement and also now as well. Now, we've got a bit of a case study here. We're going to introduce Tina, who's a hypothetical Brighter Super member. Now, her situation may have similarities to yours, but we have not considered anyone's personal circumstance in this scenario. Tina has recently turned 55 and is in a position to make additional contributions to her super. She's looking at putting in an extra $5,000 per year into her fund via salary sacrifice. Now, in option A, if Tina chooses not to contribute, she may retire with a balance just over about $258,000. However, in option B, if Tina contributes that $5,000 per year for 5 years, she could potentially grow her super to just over $280,000, which includes savings of over $4,600 in tax along the way. Based on the assumptions and considering her circumstance, Tina may be able to save money in tax and boost her super balance by contributing extra via salary sacrifice to her super. And as you can see, as I said earlier, these small changes over time can make for bigger difference in that long run. Now, at Brighter Super, we are here to help you. Our website contains a range of resources, including our salary sacrifice calculator. It allows you to find out how you can maximize your super by contributing before and or after tax contributions. You can find this and other calculators under the resources tab, and it takes about 10 minutes to complete. It also gives you the option to see if you can afford to contribute more by reducing your take-home pay. Remembering small changes today can make for big differences in the future, and this calculator is a really great starting place to have a look and see what that could look like for you. Now let's discuss some other types of contributions in more detail. This one was pre-submitted in the questions for today's webinar, and it's called the carry forward contribution. Now, some of you might have heard about this. It is relatively new, but a person may be able to access unused concessional caps from previous years based on several criteria. It came in effect in the 2019-2020 financial year, and eligible members have up to 5 years to use any unused concessional amounts. So for example, if a member has unused concessional amounts accrued in the 2019-2020 financial year, the last year they are able to contribute those amounts is 2024-2025, the current year that we're in. So to be eligible, you must have a super balance under $500,000 at the start of the financial year in which a contribution is to be made. Now, remembering again, concessional contributions may include everything that you salary sacrifice or what you claim as a tax deduction. You can track your concessional contributions through MyGov. This can help if a member has taken time out of the workforce and can be an opportunity to really get back on track. Remember, any money put into super is generally only available once you reach retirement age. For this strategy, we recommend seeking advice to ensure it is right for you. And there are also other ways in which you are able to get extra money into superannuation as well, like these ones on screen. Now, depending on your personal circumstance, these are a couple of other options. In addition to previously discussed the carry forward contribution, there are other contributions like spouse contributions, bring forward contributions, downsizer contributions, government co-contributions, and the low income tax offset. Like anything, rules and eligibility apply. So for further information, please visit our website or reach out to us and we'll be happy to go through them in more detail. So a little bit of a breather. We've just gone through a lot around contributions. But once we have money in our superannuation, then we want to be able to grow it and sustain it throughout our retirement. So we need to do this through investing. The reason why investing produces a return is because there's a risk involved. If you give someone $1 and expect them to pay you back $1.20 by next year, there is a risk that you won't get any of your money back. This is the key to investing, understanding that risk level. Brighter Super's aim is to grow our members' superannuation balances while providing consistent returns. This means we want your investment to grow when markets are performing strongly and reduce the impact when markets start to fall. We place great value on diversification, which means not having all your eggs in one basket. To achieve this, we offer ready-made investment options which spreads your money across a number of different asset classes to reduce the level of risk. Each of our ready-made investment options offer the benefits of our strategically chosen investments. Now, depending on what stage of your working life you're at, what your retirement goals are, and how long you've got before you retire, you may want to take less or more risk. And we have options for everyone. We are going to talk a little bit about these over the next couple of slides. Some people think of their super as a single asset, but it can potentially be invested in many different assets. Most super funds offer different types of investment choices to their members. Investment choice is selecting which asset classes you're invested in, such as Australian shares, international shares, fixed interest, cash, or property. Investment options offered by super funds can either be diversified, so that means they're investing in a mix of different asset classes, or single sector options, which means investing in just one single asset class. Diversification can be achieved by choosing a ready-made diversified option, such as growth or balanced, or by choosing a mix of single asset classes yourself. So choosing a mix of potentially diversified options and also single asset classes as well. Now, a poll question here, our next poll question is, do you know, I should say, which investment option you are in? That one's just popped up on your screens there. Some good results coming through. Okay. So we've pretty much got a 75-25% split in our audience today, which means most people do know where they're invested, which is great. And that's because everyone's situation is different and we really need to make sure that our investment choice is aligned with our goals and our needs. For those of you who don't know what you're invested in, I highly recommend jumping into your member online account and checking that out. Or if you don't have access to that, having a look at your statements. Otherwise, booking in for an appointment to chat with us and we can talk you through that as well. And I'll tell you how to do that as we go on in today's session. Now, I will say assets such as equities, otherwise known as shares, are described as growth assets. These may see volatility over the short term, however, and the value goes up and down, but over the longer term, they generally experience higher growth. Asset classes like cash and fixed interest, on the other hand, are sometimes described as defensive assets. So they carry less risk in terms of volatility of returns and potential for capital loss, but they also offer less potential for higher returns. So these options are generally described as low risk, low return. Ready-made diversified options are made up of different mixes of growth and defensive asset classes together. Now, often when I'm talking to people about investment choice, I'm often asked the question, what is the best way to invest my super? And as you can probably imagine, there is not one single investment option or profile that will be fit for everyone. In fact, there are a number of different things to consider when choosing the right risk profile for you. So what is the right risk profile, you may ask? Now, a risk profile is an individual measure of how you feel about risk and return, keeping in mind that there is always a trade-off between these two. It takes into account your tolerance to market falls, as well as your investment timeframe and desired returned outcomes. Now, in a perfect world, we would love high returns without any falls. However, generally speaking, the more risk you take, the better return you should expect in the long term. However, the greater chance for bigger swings, including negative returns in the short term. So, for example, an aggressive investment is expected to generate a higher return over a long period of time. However, it is likely to fluctuate more in value. What this means is that your investment may grow faster over time. However, it will generally lose more when market dips, and produce more negative returns. More frequent negative return years. So essentially saying they have higher highs and lower lows. A more conservative investment, on the other hand, is likely to have fewer negative return years overall and may not drop as far as aggressive investments during a downturn. However, the trade-off here is less downside risk, is that the positive returns are expected to be lower over the long term. Okay. So understanding your risk profile and your investment risk is important to help better prepare for market movements and make informed decisions. Being invested outside your risk profile is a risk in itself. If you're invested too conservatively, that risk may be missing out on potential returns that you could have had. If you invest too aggressively, you may see greater falls during market instability than you were comfortable with. Both of these scenarios do not result in an optimal outcome for you, so it's important that you know where you sit. You can find the investment risk profile on our website as well under the resources tab. And if you'd like to learn more about investing in super, we recommend you register for our upcoming webinar called Investments Basics. Okay, so moving on to our insurance information. So often a tax efficient way to take out life insurance, or otherwise known as death insurance, total and permanent disablement insurance, and income protection is through your super. Now, these are very important insurances as they ensure your loved ones are taken care of if you can no longer take care of them yourself. Your employer's super contributions and salary sacrifice contributions are taxed at 15%. This is lower than the marginal tax rate for most people, and this can make paying off your insurance through your super quite tax effective. It is important to only insure what you need for the right level of cover, so you are not paying more premiums than you necessarily need to. Now, there are 3 types of insurances you can include within your super: death insurance, total and permanent disability, and income protection. Death cover provides your loved ones with a lump sum if you are to pass away. Total and permanent disability pays you a lump sum if you are to suffer total and permanent disablement, which means you're never again able to return to work for what you have education, training, or experience in. And income protection pays you an income if you're injured or otherwise unable to work. Now, life insurance pays your loved ones if you pass away or become terminally ill. This means they don't have to worry about money during what will already be quite a tough time. These are important insurances. Oftentimes they may be default insurances for you as well, so something to have a look into, but you need to make sure that you have the right level of cover for yourself. Now, we've covered off a lot already today, but one last thing we want to highlight is who your super goes to in the event of your passing. Super funds can generally only pay to a dependent or your estate. Dependents are a spouse, child or children, financial dependent, or someone that you're in an independent relationship with. There are a couple of beneficiary nominations on the screen, but one I want to call out is a binding nomination. Now, a binding nomination legally binds Brighter Super to pay your death benefit to your nominated beneficiary or beneficiaries. This requires a specific form to be completed, which we can find on our website and must be valid at the time of your passing. We have listened to our members, and you can now select the non-lapsing nomination, which means you do not need to review your nomination every 3 years, which is something that we used to have, and we're very happy to have a non-lapsing option now for our members. One last thing to consider after this webinar, check your nomination, your current nomination, which can be found in your member online account. It's really important to review regularly because obviously if you were to pass away, you want to make sure that your funds are given to someone that you actually want to receive them. We can understand that this can be quite a complex issue, and we have dedicated beneficiaries webinar, which takes place regularly. The next one is taking place on the 8th of August. So please visit our seminar page if you'd like to register, and that is a good one to get across everything beneficiaries. So, what are some of the actions that we can do today to make sure that our superannuation is on track? It may be worth considering to consolidate your accounts. But what does this mean? Well, it means having multiple accounts, which may not be uncommon if you have had a range of different jobs. You can search for lost or unclaimed super held by the ATO by visiting the MyGov website. From here, you can also consolidate it in your MyGov website. You can also consolidate it through your Member Online website as well. There are a few reasons why this may be a good idea. Firstly, if you have accounts with multiple super funds, you may be paying multiple sets of fees. And also consolidating your funds may save you a little bit of money. Having all your super in one place can also reduce your paperwork and make it easier to track, a lot easier to track. Additionally, depending on your objectives, it is important to review the performances of all your funds of which you are a member and consider this as part of your decision-making process. Now, there may also be reasons to retain multiple accounts, and consolidation may not be the right option for you. So before consolidating, ensure you review your insurance, your investment arrangements to make a formal decision. If in doubt, definitely seek some personal advice. So before we move to our question and answer section of the webinar today, let's summarize some further actions you may wish to take. Now, consider if you need to have duplicate accounts, you may be paying 2 sets of fees and insurances. Not all of us know we have duplicate accounts, so if you've had a lot of jobs, you could be one of them. Also, looking to the balance, if you think there isn't as much as you thought you should have, you may have another account elsewhere. You can also book in for a super health check with us. This is at no additional cost, and it is open to non-members as well. And I'll explain shortly how to do this. Make sure you have registered for Member Online if you haven't already. From here, you can manage your super online and update things like death benefits, investments, update details, and consolidate your accounts. Another action to consider is advice. Now, today we've talked about the importance of getting advice at a couple of different occasions. What do you think? Do you know that limited advice is included in your membership as well? So it's not going to cost you anything extra. We'll come back to what that means in a minute. Now, as I mentioned earlier, as a boutique fund, we are here to offer you many services, one of which is our Super Health Check appointment, which is a 30-minute appointment with us, it's got no additional cost. And the Super Health Check covers you for a lot of different questions, like how to potentially increase your take-home pay through salary sacrifice, how combining multiple superannuation accounts could save you time and money, paying the right insurance premium for your type of occupation, and learning how much you may need to retire on comfortably. If you would like to book a Super Health Check, and I highly recommend if you've got any questions or want to know more in details about your account to jump in and book one in, there is a QR code on your screen. You will also receive a link to book a Super Health Check in the coming days, along with today's webinar recording. So as I mentioned earlier, we offer a range of personal advice services suited to the individual needs of the members. If you're looking for specific information about making contributions or investment strategies, our intra-fund advice team can help. So this is the team that you can book in for at no additional cost. And it's all built in your membership, and they'll give you personal financial advice around contributions and investments and insurance. So a really good service. If you haven't taken it up, it's at no additional cost. I highly recommend talking to us about that. Two of the most common questions members ask as they approach retirement are how much super do I need to retire and do I have enough? To answer these questions, a retirement health check is the type of advice that you need with one of our financial advisors, and they'll provide you with an in-depth explanation and tell you exactly what you need to know in regards to those questions. It's a great service. We also offer both scaled and comprehensive personal advice services as well. Now, comprehensive advice and scaled both take into account a complete view of your financial situation to tailor the advice to suit your individual needs. It's a face-to-face meeting with one of our advice team in Brisbane or various regions all over Queensland. These appointments may also be arranged by digital channels like Zoom, Teams, those types of things. The cost will depend on the complexity of the advice, and it may be deducted from the balance of your superannuation depending on the type of advice that's offered. Now, it's never too early to start planning for your retirement, so please talk to us about how we can help and what type of service is best suited to your needs. Similar to today's 101 webinar, our seminar webpage includes a range of upcoming webinar topics. Keep an eye on this page and we'll update it regularly. Now, on the previous two slides, we discussed our range of advice services. These cover our super health check appointments, our intra-fund advice appointments, both of which are at no additional cost to our members, to the other types of advice, such as the retirement health check, scaled and comprehensive advice. In our next poll, I'd like to ask you, after today's webinar, are you planning on getting some advice? A couple of results coming through. Yeah. So it looks like, majority of people are, and that's great. I'm happy to hear that, because we know at Brighter Super that the members that go on to get some level of advice through Brighter Super, or some level of advice in any capacity, will end up with a better retirement outcome because they've had that advice. So if you are thinking about getting advice, or you've got some booked in, great. If you're thinking about booking it in, please let us know and we'll be able to help you get that booked in, because realistically, it is a great service to be able to get you on track for the best retirement outcomes that you can have. Now, I have covered a lot of ground today, so remember, you can also visit the resources tab for the calculators that I've mentioned, forms and info sheets for more information of what we discussed today. Sorry about that. Now, we have tried to answer your questions throughout this webinar today, but I'm going to invite Gemma back on screen to answer any questions that we couldn't get to in the Q&A chat.
Thanks, Cal. Yeah, we haven't had any questions, so I'll just hand back to wrap up.
Perfect. Well, if you do have any questions after this webinar, always reach out to Brighter Super. We're definitely happy to answer any of your questions. Now, I am just going to leave our Super Health Check page on the screen there, because if you are wanting to ask any questions, potentially not in this webinar, but just with one of our consultants, that is a really great way of getting a good look over your account and having those questions answered. But I would just like to say thanks again for taking the time today to come along and attend our webinar. One last question before we bring things to a close. Overall, how satisfied were you with today's webinar? We always like to take feedback. We also always like to make sure we're doing the best we can for our members, and we also always want to make these webinars bigger and better. So we'd love to hear what you have to say. All righty, thank you for sending those through. All right, thank you very much. That's it for me. Thanks so much for sticking around, and we hope to see you all soon.